Welcome to the weekly review of the markets from Hernandez Retirement Services. This is Agustin Hernandez. This week, I will focus on the results of the S&P 500 index, the U.S. 10-year Treasury note, and gold for the week ending December 7th, 2018. I will also go over some other indicators traders use to get a feel for the markets. Before we begin the charts, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts reference are subjective. No strategy can ensure success or protect against loss. Investing involves risk, including loss of principal. Our first chart is the weekly S&P 500 index. The time frame I will use is the last 52 weeks ending December 7th. For price, I will use the open, high, low, close bars, with green being a positive week and red being a negative week. Finally, this week I will use the long-term 40-week moving average, which is represented by the black solid line. Now, the previous week we had a nice positive pop in the market, but last week's losses erased whatever good vibes we had. The S&P 500 fell 4.06% last week. What makes this loss even more negative was that the week started off on a very positive note, but with fears of a possible slowing economy, trade wars, and finally rising rate fears, it was too much for the market to take. Now, more importantly, is that the S&P could not hold above its 40-week line by weekend. Also, right now, this index is stuck in a short-term trading range, where we are getting lots of whipsaw action. For now, the positive of this index is that it has held above its lows of the year. The negative is that the 40-week moving average line is starting now to flatten out. More negative weeks will get this slow moving line sloping down, and that is never a positive. Now in this chart, we take a look at the CBOT 10-year Treasury note price. I will be using the same indicators and time frame as we did in the previous chart. Here we see from left a struggling asset. In fact, the 10-year note has been below its 40-week line before the beginning of this chart, and price has been falling all year until October. Now, there were some attempts at rallies in May and also in late September, but neither of these rallies was strong enough for the asset to get above its 40-week line. Now, over the last month, this government bond index has not only rallied, but actually gotten above its 40-week line. In fact, it was able to start and finish the week above its key indicator. The positives about this asset is that price is above its important moving average, and also the moving average line is also beginning to flatten out. So, if you like these government bonds, this is good news. Now, these bonds usually do well in times of stock market distress, so it may not be good news for the stock market. Now, the key for this asset to continue an upward trend is that when it finally has a pullback, can it stay above its 40-week line? Another asset that is associated with the fear trade is gold. Here we see the gold continuous contract trying to get into a new uptrend. Now, early in the year, gold did get above its 40-week line, but it was short-lived. After that, it fell. At the same time, the US dollar was rising. Now, with the US stock markets under pressure and the US dollar stalling, this precious metal is trying to flex its muscles. Before we can say it is in a new uptrend, it will need to get above its 40-week moving average, and the 40-week line will need to begin an upward slant. For now, it is an asset to keep an eye on, but it still needs more work before we can say it is in an uptrending rally. The S&P Bullish Percent Index, also known as the BPI, is a breadth indicator based on a number of stocks on point and figure buy signals within an index. Based on the point and figure, a stock is either a buy or a sell. So an index is bullish when 50% or more of its stocks hit a buy signal. Now, as of last week, 43.4% of stocks in the S&P were bullish or in a buy signal. So based on that, we do see some weakness in the index. Now, I do want to show a couple of other things on this chart. One is that this indicator shows that the S&P index had more stocks in buy bullish signals in January of 2018. Since the pullback, the high for this indicator has only been 69%. The lows of this indicator happened in late October at 31%. Now, this is telling me something, but not everything. As I have stated, indicators and price by themselves tell us one thing, but not everything. Here we have the New York Stock Exchange Advanced Decline Issues Index. The NYSE Advanced Decline line is a breadth indicator based on net advances, which is the number of advancing stocks less the number of declining stocks. Net advances is positive when advances exceed declines, and negative when declines exceed advances. The AD line is cumulative measure of net advances. It rises when net advances is positive and falls when net advances is negative. To keep it simple, it goes down when the number of stock issues are going down. It goes up when the number of stocks are going up. Here I have inserted the 40-week moving average to give us a perspective on where stocks are. At the close of December 7th, the AD line was under its 40-week moving average. Now, this index is currently in a downtrend since August, but for now it has not breached the lows of the year. But like I said about any stock or bond index, I don't like it when any index begins to struggle around its 40-week moving average. And since October, that is exactly where it's been. Now let's put the S&P together with both indicators I just showed. The top chart is of the S&P 500 index. The one below is the NYSE Advanced Decline line, and the bottom one is of the Bullish Percent Index. The reason why I bring these three charts together is because we can start seeing a story being formed. First, let's look at the S&P 500 and compare it to the NYSE AD line. Now, the AD line represents more stocks than the S&P index, but traders still use it just to get a breadth of the total stock market. Now, for the most part, this index and indicator have moved in lockstep. But in late August, going into September, we can see the S&P rising to reach a new high. But let's look at the NYSE AD line, and this line peaked in August and not September, which is the opposite of what the S&P did. So what does this tell traders? Well, that despite prices going higher, there were less stocks participating in the rally. Now, this does not necessarily mean a bad thing as long as the rally continues, but it does begin to show possible weakness as lesser stocks are in rally mode. Now, after that, we do see that both charts have struggled to stay above their 40-week moving average. Now, let's get to the S&P and its bullish index. Now here we can actually see price of the index versus how stocks in the index are measured by the point in figure bullish index. Now the S&P peaked again in September. But there were more stocks in this index identified in rally mode in January. Again, what does this tell us? Is that not all stocks in this index were participating in the rally later in the year. So though it does not mean a pullback or a crash is coming, it does show that this index was being carried by fewer companies than the first rally in the year. Now to show you how these indicators help us read a story, I will take us back to 1998-2000. Here I will use the Nasdaq Bullish Percent Index versus the actual Nasdaq. This chart will show at the beginning of the tech boom and the eventual bust. Now the top chart is of the bullish index, which again identifies stocks as either being bullish or bearish according to the point in figure charts. After a pullback in the summer of 1998, the number of stocks rose. But interestingly, it peaked in July of 1999. In fact, during the last fear of missing out hysteria from November 1999 until the peak of the Nasdaq in March of 2000, the highest percent of stocks in bullish mode never got above 50%. So in hindsight, this tells us that there were certain stocks in the index that carried the majority of this metric rise from the peak of the bullish index. So yes, few companies can carry the load for a long period of time, but when they begin to collapse, look out. Now this chart I show the S&P 500 for the year 2007-2009. Here the top chart is the S&P 500 index. The one below is the NYSE advanced decline line, and the bottom is the S&P Bullish Index. Now here we can see both the index and the NYSE advanced decline line moving pretty much in lockstep during this period of time. Now there were times that the S&P was able to move above and below its 40-week line, while the NYSE AD line was below its 40-week moving average. Now the NYSE AD line did peak above its 40-week moving average in May of 2008, while the S&P only kissed its 40-week moving average. After that, price and stocks participating both fell. Now, the S&P Bullish Index, for the most part, follows price exactly of the S&P Index, which shows there was broad S&P market weakness. But one thing that is of value for traders is the final months of this chart. From October 2008 until March 2009, the number of stocks considered bullish rose, while the S&P price during that same period of time fell to a low. Some traders feel that divergences like these, where price goes down while percentage of stocks being bullish rise, can be an early indicator that the bottom of price may be near. What does this mean? Unfortunately for the S&P 500, price is stuck in mud. The good news is that it has not fallen and broken below the lows of the year. The bad news is that there does not seem to be strength to get it back above the 40-week moving average for now. Also, the NYSE Advanced Decline Index and the S&P Bullish Index both show weakness to back up the depressed price action of the S&P. So for now, again, we need to be cautious investors of this index. The 10-year government note and gold are trying to wake up from their price slumps. For now, the note was the first to break out and will try to prove that it is in the beginning of a rally, and gold still has more work to do to get in a new uptrend. I would like to thank you for viewing this video and I hope it was helpful. Please subscribe to my channel for future videos.